So in the last Polygon video, we were talking about quite a few things, and it was an educational video. And I say it time and time again, you look after the risk and the reward will look after itself. People focus on the reward too much and they don't understand what the risk is. That's how you can use risk management to your advantage. That's how you can be successful as far as trading is concerned. And we were talking about quite a few things in the last Polygon video, the tightening of the wedge and the significance of that. That was the bears being exhausted. That was the sellers having their last turn before we had any kind of break. Once we'd got momentum, that signaled the break. The break has actually happened now. What we managed to do in the last video was a few things to set us up for this video. We managed to take out the volatility of the spikes to the upside and the spikes to the downside, which is represented by the wicks of the candle. We went into the line chart. The line chart gave us one thing. That allowed us to understand where the close of the day was. That's the significance, the close of the day. So when you understand the close of the day, that helps you do one thing. It helps you add in your support and resistance. And all we did was join the dots. How many touches did we have? How many touches did we have? And then that allowed us to build in our support, build in our resistance. So that's why this video is going to follow on, guys, because we waited for one thing. We waited for the break. Once we'd had the break, then we understood where the risk lies and where the reward lies, how you can actually play this trade. Okay, guys, so this is a little bit different because this is going to be an actual lesson in trading. It's something that I don't do where I say, this is what I'm going to do. This is how I'm playing it. This is my risk. This is my reward. This is how I'm taking it. And I'm going to show you step by step because we went through most of the analysis in the last Polygon video, guys. I'll leave that at the end of this video so you can understand step by step how we can go through a process to set up a trade. And then when this happens, you can take advantage of that. So we've had the break, guys. We're a few days late, 1, 2, 3 days late as far as the break's concerned. How can you play that and understand the risk to reward? And what is the actual reward in comparison to the risk here? So you bring your risk to reward tool up. If you took this trade here, this is going to be your risk, your reward, sorry. This is going to be your risk. Why is it going to be your risk? What's the significance of this breakout here? So that breakout is your momentum line. Remember, guys, when you're bullish and you're putting in higher highs, putting in higher highs and higher lows, that is your momentum line. This is your momentum line. Once you break down from this level, that signals that the bears have regained control. You're likely to come up, test that as resistance, put in a lower high and come back down. Now, that is the bullish scenario. The bearish scenario is this. This is the bears momentum line. Once the bulls break through the momentum line, that's signaling that something's changing, and that helps us identify risk. So we understand that once we've broke momentum, we're wrong once we take out the previous low. Now, what is the significance of breaking this momentum line here? If you haven't broken the momentum line, you're likely to continue the trend down because this is resistance until it's broken. So once it's broken, that signaled one thing. The buyers are outweighing the sellers. We had a big divergence here. We talked about the big divergence in the last video. What happens when you've got a divergence? Once you've got a divergence and you start putting in those higher lows on the RSI, that's signaling that there's more buyers than sellers. And when the chart isn't showing that, that's representing that the chart needs to catch up. So it's all about probabilities, guys, understanding exactly how you can get the best risk to reward. Is it good now, and how can you take advantage of this? So from a trading perspective, you can use one thing. You can use a laddering in process. How would you ladder in here, guys? Because there's a possibility that we could reject at this level and come back and test support. How do we know that? We can look at the stochastic. We're now overbought. So we're overbought on the stochastic, signaling that there's potential downside. The aim of the game, guys, when you come back into oversold on a stochastic, this candle needs to be higher than this candle here. That means that the bulls have regained momentum and you've put in a higher low as this has come all the way back down to oversold. So that is one way that you can play it. You can use the waiting game, guys. Wait for this to come back down on the daily. When it comes back down on the daily, you can understand, is it holding support, which was previous resistance? And if it is, once it's come back down to oversold, it's a high probability that that was the actual low. So what is the area that it could pull back to, guys? This is the significance here because that area was rejection for 1, 2, 3, 4, 5, 6, 7, 8, 9 days. 9 days of rejection. Once you've broke through, that is showing additional confluence that the bulls have got more momentum than the bears as far as buying pressure is concerned. So if price action pulls back down to this level here, and the stochastic comes back down into oversold, that is going to be the best buy, and that allows you to bring down your risk to reward. Once you bring down your risk to reward, guys, what does that allow for? It allows for preservation of capital. It's the main thing. Understanding your risk, looking after your risk, and preserving your capital allows you to live for another day. So it doesn't mean go and buy Gala now because Gala's pumping. Does it mean it can't go higher? It doesn't. But one thing that it allows for is for us to understand exactly where the resistance points are. So guys, this is going to be a lesson in trading. How can you take advantage of something like this? Ideally, I want to bring my risk down to this level here. Once I've brought my risk down to this level here, and the stochastic comes back down into oversold, then that's indicating that the bulls have got strength, something's changing, the bears have lost control and they're getting exhausted. And that's how you can play it, guys. So the upside from the previous swing is all the way up here. This goes back to December 2024. Does that mean that that's where you should put your profits? Well, you can put your profits there, guys, but how can you actually play the trade? This is how you can play the trade. If it comes back and tests this, you can take an entry, a small entry. And when I mean a small entry, guys, I mean look after your capital. And this is not financial advice. This is just hypothetical training and showing you something that I'd be doing. So if you've got $1,000 in a trading account and you're looking to ladder your position in, on something like this, I'd be looking to take either $25 and $25 with two positions, or $50 and $50 with two positions, with a tight stop loss, guys. Remember, the stop loss is your capital. So if you put $100 on a trade and then you've got a 20% stop loss, then that is the risk. It's not the whole lot, guys. The 20% is the risk. So remember that and understand what the risk is. The better the pullback and the better and stronger the support, guys, the lower the risk, because you understand that once that support is being dropped, that means that you're wrong. And if you're wrong, you want to be out with the least amount of capital possible. Right now, how can you play trailing stop losses, guys? You see trailing stop losses on exchanges all the time where you can go and say, right, 3%. I'm going to put a trailing stop at 3%. Absolute bull, guys, absolute bull. We're talking about swing trading here. So what you're looking to do, if you took a risk, if it done something like this and it's come back, and you take entry one here, and then it goes up and puts a new high. Where are we expecting resistance, guys? We did it in the last video. We're expecting resistance here, just under 30 cents. So at 30 cents, if we got a pullback and then this previous resistance here confirmed support, and then we've got another push to the upside to the next resistance level, we've built it in. What that allows for is for you to bring your stop losses up into profit. So that trade, ultimately, you've diminished your risk and then you've increased your stop loss. So that means you're in profit. So if it goes wrong, that means you're wrong in profit. However, the trend is your friend until the bend at the end. So treat it as that. What will end up happening, guys, is we've got the momentum line to the downside. That's the bear's momentum line. You'll create a momentum line to the upside. You need to understand that once this momentum line's broken, then the chances are that you're going to be out. So the more that you can increase your stop loss as you're putting in higher lows and then you're putting in higher highs, you understand one thing, that whenever it is that you're wrong, at whatever resistance level it decides to reverse and pull back, that means that you're in profit and you're in profit. There's a chance that you can ride it all the way up to the top. There's a chance you can ride it to these resistance levels. There's a chance you can ride it there. However, your risk's diminished. You've already got some reward, and that means that you're banking and banking and banking all the way. What that allows for, guys, it allows for you to continue all the way up the trend until the trend's finished. And that's the best thing to do as far as trading is concerned, guys. Minimize your risk as soon as possible. If you can, and it puts in a new higher low, put your stop loss below that new higher low, put yourself in profit, take away your risk, and let the reward look after itself.